Welcome back to Investing Talk podcast.
Today we're focusing on UnitedHealth Group and its upcoming earnings to watch.
This is definitely a big one. Before we get into what to look for, be sure to subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, so let's break down the key things we'll be watching for in this report. UnitedHealth Group is, well, it's really the bellwether for the entire U.S. healthcare system, wouldn't you say?
Oh, absolutely. They're the lens, the lens through which we see everything from national medical cost trends to how well things like Medicare Advantage and value-based care are actually doing.
Exactly. And understanding their structure is key. They've basically got these two core parts.
Right. You've got UnitedHealthcare, that's the insurance side, the benefits segment everyone knows, and then there's Optum.
Yeah, Optum. If UnitedHealthcare is kind of playing defense, managing risk, and paying claims, Optum is the offense. It's the health services business.
The part designed to actually tackle the utilization problem everyone's worried about?
Precisely. Pharmacy care, data analytics, operations, pushing that whole strategic shift towards value-based contracts. It's meant to bend the cost curve.
Okay, so that integrated model, you'd think it would make them somewhat predictable. But for this upcoming Q3 report, it feels like the market's kind of lost its crystal ball.
That's a good way to put it.
Yeah.
Let's talk about why there's almost no standard consensus data going into this announcement on October 28th.
Yeah, what's going on there?
Well, we know the date, October 28th, covering Q3, so July through September.
Yeah.
But usually, right, we have pretty clear targets from analysts, revenue, UPS forecasts.
And numbers everyone expects them to hit or beat.
Exactly. But for this specific Q3 report, verifiable consensus estimates, they're just absent, at least based on the sources we're looking at. No reliable revenue or EPS consensus.
Wow. Okay, so that's a huge hurdle analytically, isn't it? We're not just flying blind, we're sort of flying without even knowing where the target's supposed to be.
That's it. It seriously bumps up the uncertainty level for the stock.
Great.
The reaction on the 28th won't be about beating expectations in the usual sense.
It's more about the report establishing what those expectations should even look like going forward, almost like a reset.
Pretty much. So we have to fall back on context. We look at the trajectory from the first half of 2025. What did those numbers show?
Well, they showed really strong revenue growth, right?
Very strong. For the 6 months ending June 30th, total revenues jumped 11.3% year over year, at $221.2 billion.
And net earnings look much better, too, $10 billion. But that's compared to the period last year that had those huge cyber attack costs, so a bit of an easier comparison.
True, the recovery is good, but here's the kicker. You dig into the cost of that growth. That's where the major stress point is. Medical costs soared.
How much?
15.8% year over year in the first half. Reached $152 billion.
Wait, hang on. Revenue up 11.3%, but medical costs up 15.8%. That doesn't sound sustainable.
It's the core issue, not just for them, but the whole sector. It reflects membership growth, yes, but also, crucially, people using healthcare services again, things they might have put off.
So pent-up demand hitting the system, procedures, doctor visits, all costing the insurer more.
Exactly. And that brings us squarely to the single most critical metric everyone needs to watch in this report.
Let me guess. The MCR.
You got it. The medical care ratio, or MCR, specifically for the UnitedHealthcare segment.
Right. Forget the big revenue number for a second. This is where the profit story is.
Absolutely. It tells us for every dollar they collect in premiums, how many cents are going straight back out to pay medical claims. It's the clearest view we get of margin pressure.
Okay, so what's the benchmark? Where was it last quarter?
In Q2 2025, it was hovering around 89.4%. So 89.4 cents of every premium dollar went to medical costs.
So if that number ticks up in Q3, say towards 90% or even higher, that's bad news. It means utilization is still running hot, costs aren't under control.
Precisely. Any significant move away from that 89.4% mark, up or down, driven by utilization trends or cost management success, that's likely going to determine the stock's immediate reaction. It's a headline number.
Okay. Beyond the MCR, though, what about strategy? Things specific to Q3. Management did reestablish their full-year outlook back in August, didn't they?
They did, which to me suggests some internal confidence. Maybe they felt the utilization spike was peaking, or at least manageable within their forecasts.
And that confidence must tie back to Optum, right? Their long game.
Has to. Optum's continuing that aggressive rollout of value-based care initiatives. They're trying to fix the problem from the inside, control the care pipeline, improve outcomes, not just pay bills after the fact.
And Q3 is also a key period for Medicare Advantage, isn't it? Even before open enrollment really kicks off.
Right. September and October see all that intense competitive campaigning for the next plan year, 2026. So any commentary on how MA enrollment is looking, retention, profitability, that'll be really important.
Okay, so internal factors like MCR, Optum, MA, but you also mentioned external things, market structure stuff.
Yeah, we can't forget those. The earnings report isn't the only thing that could move the stock soon. Think about late November major ETF quarterly rebalancing.
Ah, so passive flows. If healthcare's weighting changes in big indexes, that could push the stock around regardless of the earnings specifics.
Definitely. It can amplify or dampen whatever the earnings reaction is. And then further out, mid-December, we get the institutional 13F filings.
Showing what the big money managers, the hedge funds and mutual funds were doing with their shares back in Q3, a look at their sentiment before these earnings even came out.
Exactly. It gives you a sense of how the smart money was positioning.
All right, so let's pivot to scenarios. Given all this uncertainty, especially the missing consensus numbers, what does a genuinely bullish outcome look like? What makes the stock go up?
Well, the dream scenario is utilization normalizing faster than people feared. That shows up directly as a better-than-expected MCR. Maybe it even dips below that 89.4% Q2 level.
Okay, so MCR improvement is number one. What else?
Strong Medicare Advantage membership retention figures would help. Robust growth from Optum Health, especially if they can point to success in those value-based care contracts. Oh, and positive comments about their specialty pharmacy expansion could add fuel, too.
Makes sense. Now, the flip side. What are the risks? What could be hiding in the report that tanks the stock?
The number one risk is just continued high medical costs, an MCR that stays elevated or climbs higher, confirming that utilization spike isn't fading yet.
That seems obvious. Anything else?
Margin pressure from Medicare Advantage. If management sounds worried about rate adequacy for 2026, basically, not getting paid enough for the risk they're taking on, that would be a negative.
And acquisitions, they've done deals, right?
Yeah, you can't forget potential integration challenges or unexpected costs from pending acquisitions mentioned before. Any hint that those are dragging on earnings or adding complexity would likely hurt the stock.
Okay, which brings us back to actually trading this. You mentioned the lack of consensus and how that messes things up.
It really does.
Yeah.
For anyone thinking about directional bets, buying the stock, selling it short, using options, the risk is just way higher without those usual guideposts. No consensus, limited implied volatility data to gauge expectations.
It makes it incredibly hard to judge whether the actual result is good or bad relative to what the market was implicitly pricing in.
Exactly. Expectation management is near impossible. And given how volatile healthcare stocks can be around earnings historically, investors need to brace for potentially large moves. We're talking 5%, 10%, maybe even more.
So if you already own the stock and you're feeling nervous about this specific report, this uncertainty, what can you do tactically?
Well, one approach is sector hedging. Think of it like isolating the company's specific risk.
How does that work?
You could use a broad healthcare ETF, for example, maybe short the ETF against your long position in UnitedHealth Group. The idea is to neutralize some of the general healthcare sector movement.
Ah, I see. So if the whole sector moves up or down, the ETF position offsets some of that, leaving you more exposed to just how UnitedHealth specifically performs versus its peers on earnings day.
Precisely. It helps manage that uncertainty when you lack the usual data points. It lets you separate the company's story from the overall sector trend, at least partially.
Okay, that makes sense. So wrapping it all up then, this upcoming October 28th report, it feels like a real moment of truth, doesn't it?
It absolutely does. It's crucial for seeing whether that strong H1 revenue growth can actually win out over these persistent, nagging market worries about rising medical costs.
Yeah.
And it's all going to come down to that critical MCR number.